partly the conventional wisdom for how should a central bank respond to a stagflationary shock, which I think of tariffs as having a heavy stagflationary component. The primary effect, the Fed can't pump oil, the Fed can't adjust the supply side, but it can try to prevent the secondary impacts, which could be wage price spirals, or if you start thinking about the secondary impacts of tariffs on parts, components, supplies, and intermediate goods, now it's a little more complicated than the Econ 101 version, because now the tariff isn't just staying in its lane, it's going to be raising the cost of production for domestic manufacturing and others. And that's a lot of times, certainly during COVID and post-COVID, took time to wind its way through the economy. So I do think we're going to be in the business of trying to figure out which part of these price increases are we ignoring because we think they're transitory, and which ones are we responding to. Now, that doesn't mean that we have to hold forever or for as long as it takes for the prices to come back down. It all depends on the data and what's the economic outlook. If we keep getting inflation reports like the ones we had, the first two of these four that you mentioned, I would be very comfortable that, hey, the dust is out of the air. It looks like we're still where we were, which is a strong economy with inflation coming back down. In that circumstance, I think it's totally fine. It's expected. It's the right thing to do to bring the rates down to where we think they're going to settle. We got to get some clarity from the numbers.